Opendoor stock has given us another important signal today. After a volatile session on Thursday where the stock closed at $9.94, down by 27 cents or about 2.64%, we saw the shares claw back in the aftermarket, finishing right at $10 even. And that move is more than symbolic. It reinforces the growing thesis that $10 is setting up as the new floor for Opendoor. When you zoom out and look at the action over the past several weeks, this stock has been through an extraordinary transformation. From languishing in penny stock territory, it has surged into double-digit territory thanks to leadership changes, macro catalysts, and retail energy from the open army. And now, even when sellers test the waters, Opendoor shows resilience. Each time the stock dips toward 9 or below, buyers are stepping in. That kind of behavior tells us the base is real. It tells us that market participants, retail and institutional alike, are beginning to recalibrate their expectations. But Thursday's session wasn't just about consolidation. There's another story emerging that could prove to be just as pivotal: short interest in Opendoor. On X today, a list of some of the major institutions betting against Opendoor was circulated. While the specific position sizes were not disclosed, the names alone tell us a lot. Among them are Squarepoint Operations, Group 1 Trading, Jane Street Group, Walleye Trading, and Simplex Trading. And of course, we can't forget Martin Shkreli, who has been openly vocal about shorting the stock. Now let's pause for a moment. These aren't small players. Jane Street, Squarepoint, Group 1, these are firms with deep quantitative strategies, fast execution, and plenty of resources. Their presence on the short side shows that Opendoor has captured attention not just from retail bulls, but from sophisticated traders who think the story may be overextended. On the surface, that could make some retail investors nervous. But in reality, the presence of high-profile shorts may actually be one of the most bullish signals of all. Here's why. When you have elevated short interest, you create the conditions for a squeeze. If the underlying company keeps producing positive news, and if leadership continues to execute on its plan, the shorts eventually face pressure. They're forced to cover, adding fuel to the upside. We've seen this dynamic before in GameStop, AMC, Tesla, and even in smaller names. And with Opendoor, the ingredients are all here: a passionate retail base, new leadership energy, upcoming catalysts like AI products and geographic expansion, and now, a laundry list of institutions who have positioned themselves against the company. Let's connect the dots to recent developments. Earlier this week, Kaz Nejatian officially stepped in as CEO, leaving behind a $300 million opportunity at Shopify to take this role. That's a powerful vote of confidence in the long-term future of Opendoor. He's already made waves by scrapping external PR firms and filing an SEC 8K to confirm that investor communication will come directly from him and the company's X accounts. That's a radical departure from the norm on Wall Street, where communication is typically managed by layers of PR professionals. It's a signal that Kaz intends to run Opendoor with transparency and speed, cutting out middlemen just as the company aims to cut out unnecessary middlemen in real estate. Then we had the unveiling of Ernie, Opendoor's AI voice product trained on its proprietary data, which represents another step in building an AI-powered real estate platform. Add to that the announcement of a nationwide expansion across the lower 48 states, and you begin to see the theme. This is a company moving fast, executing decisively, and setting ambitious goals. Meanwhile, Keith Rabois has been blunt about the company's culture. He has called it bloated, saying 1,400 employees is far too many and that the company could operate effectively with just 200. He's criticized remote work and other distractions, signaling that a lean, disciplined approach is coming. That kind of cost discipline could be extremely important for profitability in the quarters ahead. And remember, Eric Wu is also back on the board, injecting more founder DNA into the mix. So think about it from the perspective of those institutional shorts. They've bet against Opendoor, perhaps expecting the company to struggle under the weight of past missteps, slowing housing markets, or execution challenges. But instead, what they're seeing is the exact opposite: a reinvigorated leadership team, rapid product innovation, macro tailwinds from rate cuts, and a retail movement that won't quit. That mismatch creates risk for them. And risk for shorts is opportunity for longs. Even Martin Shkreli's involvement is telling. He has openly positioned himself as short on the stock, but let's be honest, given his controversial history, one has to wonder whether he's truly short or whether he's playing both sides of the trade, drumming up attention and volatility for his own advantage. Either way, his visibility brings even more retail eyeballs onto Opendoor, adding fuel to the narrative that this is a battleground stock with massive upside if things break the right way. We also can't ignore the macro backdrop. On Wednesday, the Fed delivered a quarter-point rate cut, and while markets initially wobbled, the forward guidance was what really mattered. The Fed made it clear that as much as 75 basis points of cuts could be coming over the remainder of 2025. For a company like Opendoor, which thrives on housing activity, lower rates are a clear positive. They mean more buyers can qualify for mortgages, more sellers feel comfortable listing, and overall transaction volume increases. In other words, the environment is gradually shifting to support Opendoor's mission. Now, let's circle back to the stock action itself. Closing the regular session just under $10 may have disappointed some traders. But the aftermarket recovery back to exactly $10 per share is hugely symbolic. It shows that buyers are ready to defend this level. And when you consider that this defense is happening while short interest is building, the setup becomes even more intriguing. If shorts continue to push and the company continues to deliver catalysts, we may be approaching a moment where the pressure becomes too great and a real squeeze materializes. And that's where the open army comes in. Retail investors are not just sitting back and hoping for good news. They're actively engaged, sharing updates, building community, and putting pressure on the narrative. Eric Jackson's streak outside Drake's house has become legendary at this point, drawing attention far beyond the usual stock circles. His argument that Opendoor is a bigger retail opportunity than GameStop resonates more each day, particularly because unlike GameStop, Opendoor has a real business model, a real path to profitability, and real macro tailwinds. Let's also not forget that Eric Jackson himself has doubled down on his conviction. He has publicly affirmed that with the new leadership in place, he believes his $82 price target, and beyond, is realistic. He's not selling, he's not hedging, and he's not backing down. That conviction, combined with institutional shorts lined up against the stock, creates the perfect storm for volatility in the weeks ahead. So what should investors be watching next? First, keep an eye on the $10 level. If Opendoor can consistently hold above that mark, it becomes a foundation for future rallies. Second, pay attention to any further signals from Kaz and the leadership team. His willingness to communicate directly on X means we could see announcements and insights in real time. Third, watch the short interest data as it comes out. The higher the short interest climbs, the more explosive the potential upside becomes if momentum turns. And finally, stay focused on the macro picture. Every rate cut, every positive housing market signal, is fuel for Opendoor's long-term story. In closing, today's aftermarket recovery to $10 wasn't just a technical bounce. It was a statement. It was the market saying that this level matters, that the story isn't fading, and that the pieces are aligning for another move higher. With institutional shorts now in the spotlight, with Kaz, Rabois, and we're steering the company into a new era, and with retail enthusiasm showing no signs of slowing, the setup for Opendoor is as compelling as it's ever been. The next 9.5 weeks, as Keith Rabois hinted, could indeed be bigger than the last 9.5. And if that plays out, the shorts who are betting against Opendoor today may find themselves scrambling tomorrow. For long-term investors who believe in the vision of redefining real estate through AI, transparency, and speed, this is a story that is only just beginning.